today, my colleagues and I on the Federal Open Market Committee discussed overall economic conditions and decided to keep the target range for the federal funds rate at 1/4 to 1/2%. We judged that the case for an increase has strengthened, but decided for the time being to wait for further evidence of continued progress toward our objectives. The fact that unemployment measures have been holding steady while the number of jobs has grown solidly shows that more people, presumably in response to better employment opportunities and higher wages, have started actively seeking and finding jobs. This is a very welcome development, both for the individuals involved and the nation as a whole. We continue to expect that labor market conditions will strengthen somewhat further over time. Ongoing economic growth and an improving job market are key factors supporting our inflation outlook. As transitory influences holding down inflation fade, and as the job market strengthens further, we continue to expect inflation to rise to 2% over the next 2 to 3 years. Our inflation outlook also rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. So why didn't we raise the federal funds rate at today's meeting? Our decision does not reflect a lack of confidence in the economy. Conditions in the labor market are strengthening, and we expect that to continue. And while inflation remains low, we expect it to rise to our 2% objective over time. But with labor market slack being taken up at a somewhat slower pace than in previous years, scope for some further improvement in the labor market remaining, and inflation continuing to run below our 2% target, we chose to wait for further evidence of continued progress toward our objectives.